Hello and welcome. Today we're going to be interviewing an interesting company. It's a company which isn't directly linked to data centers, but indirectly it will benefit massively from the kind of data center surge that we're seeing. It's KRN Heat Exchangers. Now I'll try and, before I get to it, I'll just quickly give you a snapshot. Just in terms of the kind of opportunity available, given the fact that you've got the budget, it could well be a very, very interesting point at which we are looking at this company. The capex that they've done has come on stream since May of last year, and likely this what it does to their capacity, it adds 6x of the FY25 capacity to the company, and therefore the kind of growth that you will likely see if demand sustains could well be very strong, because they will be in a position to service that demand. Now let me talk about what I want to know first. You've got a Rajasthan facility, which is the new facility which has come on stream. There's going to be an increase in capacity utilization there from 20% to 50% in FY27. Now the company doesn't give guidance in terms of top line, but I'm curious to know whether they can log in that 50%, because at least we'll get a sense or a pulse as to whether directionally we can see a very strong ramp up in terms of top line, and we are seeing those numbers in the Q3 fine print as well. Now the second piece is with regard to ordering. Domestic, foreign and new industries. Where is it coming from? There's been a huge shift even in the company mindset. They are looking at export orders in a big fashion. They currently do 15% of their top line from exports. The expectation is that they'll get to 50% very quickly. How quickly will really be the question, and we'll try and get that perspective. Also, export margins are better. Third piece is 6x capacity ramp up. What's giving the company confidence that demand will sustain? And I also want to understand what the life of the product is and the sustainability of the demand looks like in terms of the glide path going forward, because such a large capacity setup also will come with its set of risks, and we'll try and analyze those. In terms of the margin risk, this always comes in whenever there's a spike in commodity prices, but it is very quickly compensated in the following quarter. The question is that a real risk for the company? And even in the new orders that are coming in, is there a risk with regard to margins? Unlikely, but we will ask that question nonetheless. The last piece is working capital. This has been a bit of a stretch. When does operating cash flow start to present itself is really what I'd want to know. Now let's talk about the company itself, and let's understand this one in slightly better detail. It was incorporated in 2017, operates out of Rajasthan even now. The manufacturing operations still continue to be out of Rajasthan. It's into manufacturing of customized copper aluminium finned heat exchangers. It's promoter run at this point, and it serves the heating, ventilation, air conditioning and refrigeration industries. Now let's talk about what exactly is a heat exchanger. Let's dive into that. It's an engineering device which transfers heat between two fluids. It's used in heating, cooling, condensation, evaporation or energy recovery. The end use, and that will give you a better perspective, it's room cooling, industrial refrigeration, cold chain facilities, data centers, in your own vehicles. So in the auto sector, it's used across the board, and more so in buses and the like. Now let's talk about the products, and given that you've got the use case, the products will become easier for you to understand. There are condenser coils which reject heat to ambient cooling systems, evaporator coils, they absorb heat inside rooms, fluid and steam coils which heat or cool air using fluids, condensing units, compressor, condenser, fan for refrigeration circuits. Air cooling units are nothing but evaporator coil with fan for cold rooms. Headers, copper parts, bent copper manifolds, connectors for coils is what they typically are used for. Sheet metal parts are nothing but end plates, frames, housings for coils and units. Bar and plate heat exchangers for oil coolers and locomotives and equipment. Roll bond evaporators are flat plate evaporators for refrigerators and freezers. Bus air conditioning systems, well, I'm not going to explain that. Test certification services, especially with regard to HVAC, which is nothing but your ACs, which is typically all of the products and services that they do. In terms of geography, currently 84% domestic, 16% export. By currently, I mean FY25. That is changing quickly. In terms of export markets, UAE, US, Canada, Italy is what they were looking at least till FY25. In terms of the business model, let's try and understand that a bit better. They're designed based on customer specifications. Manufacturing happens in 2 facilities. Integrated manufacturing of product happens end-to-end. And B2B supplier to OEMs is what they are. There's a cost pass-through to customers that they do, at least in terms of the raw material pricing. Let's talk about the numbers now. And the metrics itself will show you the kind of growth that they've seen. 40% on top line. Done. EBITDA has gone up by 60% plus on a 3-year CAGR basis. Profit up 66% on a 3-year CAGR basis. So clearly a thumbs up there, no concerns at all. When you're looking at the 9-month revenue as well, 40% growth on revenue, 50% on EBITDA, 40% on PAT. So no concerns whatsoever. Let's talk about the margin trajectory now, and you'll start to see what I'm speaking about. In terms of margins, it has been choppy, and not the right way to look at it quarterly. It's been choppy because raw material prices, the likes of copper, aluminium, all of them have been choppy, and that is reflecting on these numbers. But the pass-through happens in the following quarter, as I did mention. So when you're looking at it over the year, you likely see margins trending in around the 18 to 19% range. Now, the guidance seems to suggest that they'll do 20% margin on a sustainable, steady-state basis. So, cautious here because of the choppiness, but nonetheless, management commentary seems to be quite positive where margins are concerned. That's something you need to look out for. Balance sheet. In terms of the book value itself, it's at around 530 crore at the end of H1 FY26. Mind you, this is a 4,400 crore market cap company, roughly. You're looking at borrowing, which is extremely low. Capex is behind us for most part, and cash of around 70 odd crore is what they sit on. Really, so no concerns on the balance sheet. Cash flow is where there is a challenge, and I spoke about this challenge. In terms of cash flow conversion, it's not happening. You can see that from the numbers. That's what I really want to ask management on. When does this start to pick up? In terms of return ratios, look at it, extremely strong return ratios. They've always done 20% plus. Of course, there's been a bit of a fall given the equity base going up in FY25, but outside of that, it's been a very, very strong set of return ratios that you can see. So the equity, fresh equity coming in, and once this garners scale, mind you, the capex is done. So once this garners scale, this should only ideally go up. We'll try and understand this better as well from management. In terms of shareholding pattern, 71% held by promoters, so no concerns at all there. Again, it's a thumbs up. In terms of the analyst view, there are 2 buy calls, no holds, no sells. There's an upside of 21%. Why am I cautious? Only reason is the fact that there is only 2 analysts on the street tracking it. ICICI Securities and Dolat Capital. Not bad names to be tracking this one, but nonetheless, we're cautious here. 21% upside is what they see. But I'll couple this with commentary so that you get a perspective. The total new capacity added should add 5 to 6x to the revenue, to the FY25 revenue. Sustainable EBITDA margin at 20%. PLI to add 4 to 6% to EBITDA. That's the other piece I'd want to understand better. The Rajasthan Investment Promotion Scheme rebate is at around 1.5% of revenue. The new unit will benefit from a 15% tax rate. The new plant capex is 350 crore. The new plant utilization will be 20 to 25% FY26, 50% FY27, 80% FY28. Also, the export share is expected to be at 50%. That's the target over 3 years. If your revenue is going to go up 3, 4, 5x and export share is 50%, well, margins ought to inch upwards. That's the understanding. Let's talk about valuations. Just the 1 year forward, based on consensus, 31 times price to earnings is what this trades at. The average 1 year price to earnings has been 42 times. So, and that's the 1 year forward. So we've seen a bit of a fall on the stock price. But let's go across. We have Santosh Kumar Yadav, who's the Chairman Managing Director at KRN Heat Exchangers, joining us this morning. Mr. Yadav, great having you. I hope I have breezed through the company fairly well. Talk to me about the opportunity size and this large capex you've done. Right? It should last you another 3 to 4 years. Is that something which is fair to assume?
So I think just watching your all details, so main detail you have all described, However, particularly about expansion, so if you see our growth story, so we started 8 years before from now. So each year we added new facility, new plots, and then we expanded our capacity, and then continue we able to achieve top line a good way, and then we utilize the capacity. But somehow earlier was the small plot, but now before 2 years we bought big plots around 20 acre, and covered area is around 600,000 square feet, and then we built this, you can say, the largest facility other than OEM, particularly in the heat exchanger segment. And we able to see India market growth 20 to 25%, particularly in our segment. And now data center, of course, there is the one key sector for this. And in budget also government give good news for particularly data center. And we want to export quietly good numbers. But however, our old facility, you can say that it was optimized facility. We are unable to ramp up the export because export also need good quality and consistency in the your track record. So that's why we built a new dream plant, and you can say one of the best facility in terms of our sector. And now what we said, we are targeting to for 50% in the next 2 years on fin and tube type heat exchanger export. So other also we added new product as well in our portfolio. So you can say now we added almost 6 different type of other heat exchangers. So one of the bar and plate, then roll bond evaporator, then frost free evaporator, then WTO condenser, and then skin condenser. And also we added complete one new product is called bus air conditioning. So now we are able to do complete HVAC for bus air conditioning on our brand name. And then we already started the supply since last 3 months. And now we are opening our service center pan-India base. So we expecting in next 6 months, we can have our own service center and stock center in around 20 to 25 stake in all India. And then we hoping good numbers in bus air conditioning as well.
Understood. So, okay, so plenty of levers there and lots to talk about. Talk to us, Mr. Yadav, how should one look at your top line? Because and say, let's take FY25 as the base. Your target capacity utilization from the facility, at least in FY26, is approximately 20%. Should that not technically double your top line? Because what your new facility has added is 5x in terms of the existing facility or the existing capacity that you had. And therefore, 20% of that should ideally double your top line. Is that the right way to look at it, or am I looking at it wrong?
No, I think there is some maybe confusion because we said 6x compared to our that our turnover was around 300 crore. So we call it 6x compared to this, and including total we capacity called 6x. So total turnover you can keep 1,800 crore total, and that's why we said ki 15 to 20% we are going to achieve this year, and then 50% next year, and then 80% after that 1 year from new facility only. So old facility, you can say our capacity almost full. We are unable to increase, but whatever top line we will increase, we can increase from new facility only.
Okay, so that is on the FY24 base, Mr. Yadav, right? So I get where you're coming from now. So 300 crore was the FY24 top line. It should be likely 600 crore FY26. And thereafter, the ramp up should be fairly steep as well, because you'll be at 50% of your capacity by the time we close FY27, right? So your growth rate will be 50% plus on your top line. I know you don't give guidance, but I'm just trying to match the capacity utilization and the numbers that you're giving me.
Of course, number I cannot describe, but capacity, I said 20%, then 50%, and then 80% from new facility only.
Fair point. And is the capex completely done, Mr. Yadav, or is there more capex in the pipeline to go? So up to 1,800 you're covered. Are you looking at something more than that?
So earlier capex almost done. Only we have to balance 18 crore is still from IPO money. Whatever what machine we received, so we have some 1 year payment turnkey. Once successfully run off the one machine, we can pay the 10% to our vendor. So that's mainly amount is still with us. Rest we already invested, but however, to make the line balancing or capacity parallelism to then we have to do small capex still. If we have some line and it's the full capacity running, then we can add one small a machine and we can ramp up the turnover, because like land, building, utility, that all invested in well. Now we have two small capex we can do to just to make the line balancing only.
Okay, so at what point, the current facility, after all the rebalancing that happens, where can the revenue go till? Let's exclude all the small capex that you need to do, because that may not be much in terms of your overall cash flow generation. I'm trying to understand the current existing setup that you have. Where should your top line go till? You've said 1800 crore FY28, but what beyond that?
No, I said capacity utilization. Of course, this capacity we have 1,800 crore, and we will try to achieve like 50% from new facility next year, and then 80% after 1 year. Like from now, we can say 2 years, or maybe 2.5. Yeah.
Sure. No, I take your point. So therefore, okay, let's shift focus. Let's try and understand margins better, right? You're likely doing 20% margin. Sustainable is what you're confident about, but within those margins, there's PLI benefits. There's also a 1.5% state, cashback that you get, and then you also have a lower tax rate at which you're operating at. Now, I'll exclude tax, but is there a risk with regard to at least the PLI benefits that you get and the 1.5% state subsidy that you're getting?
So still, this PLI benefit we are not getting this year, and RIPS benefit also we are not getting this year. So this or both benefit will start from next financial year only, because PLI we already approved. But however, this we are unable to achieve the eligibility criteria to get the benefit. But next year we will achieve the for sure. So PLI we will get next year for sure, and RIPS our file under approval. So hopefully we will receive our approval in next maybe couple of weeks. So we expect within this quarter we will have RIPS approval, and then from next year we can get the RIPS benefit. So you can say both benefit will start from next year, and then export will increase from new facility. Also we have some good profit from there. And third, our solar we installed just last week only. So our electricity cost also will be less compared to couple of last month. And of course, income tax, once we have income in new facility, then we will get the benefit for same as well.
Does that mean that 20% is your steady state margin guidance or aspiration, if I can call it, and on top of it is what you get in terms of state subsidy and PLI benefit? And how much does that add to your margin? So 1.5% is the clear and evident state subsidy benefit that you get. So your margins go from 20 to 21.5. How much will PLI benefit your margins? Give us a sense of that.
PLI, we will get next year 5% of fin and tube type heat exchanger, and second year we will have 4%. So PLI we can get only 2 years.
And only on specific products?
Yeah, only fin and tube type. So that is our main product as of now, of course.
Okay, give me a sense of exports, because you seem to suggest in my first question that I asked you that exports, there is some requirement. I mean, basically there is more room for you to prove yourself, and thereafter export revenue will start to pick up in a much more healthier fashion. When do you expect that inflection point to come in? And what are your initial feelers when you're going to the export market? Give us a sense of that.
So export, as I said, first we have to build our new facility in terms of good infra, good machine, and good space that we already did. So now we are going to ramp up. So we have already president, one good person for our export cell, and he's still today also in USA, because last week we did the HR Expo. So this year we are going to do around 12 exhibition, including all other components. And we have good both news from Europe market and USA market. So that both trade deal also happened. So now I think we have capacity and we have good deals. So we are expecting now our growth will be good, what we planned earlier. And many customers under pipeline for sample approvals, and already we started in good numbers as well. So last week even we received one, not last week, last month we received 20 crore single order. So earlier we have like 3 crore, 4 crore order, but first time we receive one order like 20 crore value of for UAE market.
Okay, and what does the data center proposition look like from an India standpoint? Because India is trying to go big on data centers, and you work closely with them. In fact, your revenues from the data center has doubled as a part of your overall mix. So I'm sure that it's 4x in terms of revenue growth YOY, because your top line has also gone up by nearly 2x. So give us a sense on what's playing out there.
So data center, of course, now big investment coming in mainly in Visakhapatnam. So as per I have news, like 3 to 5 lakh crore going to invest in all data center in next 5 years. And I'm expecting 6 to 7,000 crore total heat exchanger they need in next 5 years. And what capacity we have, what space, what infra we have, and we are doing almost with all data center HVAC manufacturer. So I'm expecting hopefully we can have at least 50% of total data center heat exchanger with us only. So and that we will do in next 5 years.
Wow, that may be that's very strong guidance, sir, coming from you. And what will your say FY28? Maybe you're at 1,500 crore at 80% capacity utilization in terms of top line. What will be the proportion of data center versus others?
So Finantube is of course increasing in data center. So last quarter, like earlier, last balance sheet, we have last year almost 7% over top line from data center. Even but last quarter we achieved around 15%. So I am expecting the data center will increase at least 30 to 40% of our like what we are supplying. So you can expect 30 to 40% from data center only, like growth rate.
Okay, on the current base. So 30 to 40% on the current base. Okay. And if I were to ask you with regard to cash flow, that's not come through. Is that only because of the growth that you're clocking? So you're utilizing more working capital because of the pace of your growth? What explains that? And which year in which this working capital cycle will unwind for you? Because that's when you will really receive cash. And what do you do with the money?
So it's somehow not happen cash flow good because continue we are going to invest in our capex and of course doing growth. So that's why it not happen. But now almost we did big investment, but it's still inventory is increasing because earlier we have to maintain our minimum level of stock for Finantube only. But now we have added like 6 to 7 new products. So that inventory also we have built. Secondly, copper tube and aluminum foil is still we have to import, but Indian manufacturer already started factory here, but it's still like price and quality need to settle. So once they will settle, so slowly we will try to buy from local manufacturer. So I'm hoping after like 3 or 4 quarters, it will be like start to control the inventory, but it's still in next like 1 or 2 quarters, it will be like going upside because still we have to build the stock for our other products as a stock, and then also we have to give the credit to our customer for new products.
Okay, Mr. Yadav, firstly, wishing you all the very best because your business is clearly at an inflection point and it's visible, at least basis the numbers. And thank you so much for coming in and speaking with us. We'll continue to engage with you, of course, every quarter. But viewers, interesting because you have a company FY24 top line at 300 crore, looking at an 1800 crore top line, at least in terms of capacity possible. And that will happen, 80% of that will likely happen in FY28 itself. So maybe you just want to run the maths, but we are out of time on this edition of AAYC. Hope you found this productive.